Well, something a little different tonight for the bottom line. We've asked them each to bring some accepted fact about Canada's economy that they think is bogus and make the case why. Meet the bottom line Mythbusters, economic analyst and former senior bank executive Patty Croft, Unifor economist Jim Stanford, freelance journalist and broadcaster Preet Banerjee, and our own senior business correspondent Amanda Lang. So let's start with myth number one. We have a skills shortage. Young people are educated, but they just don't have the skills companies need. Remember Jim Flaherty last budget night?
There are too many jobs that go unfulfilled in Canada because employers can't find workers with the right skills.
The Canadian Chamber of Commerce buys into that too, says by 2016 we'll have 1.5 million job vacancies for skilled jobs. And here's what Stephen Harper said 2 years ago.
This is, in fact, in my judgment, the biggest challenge our country faces going forward.
True or false, unemployed people don't have the right skills. That's why they can't find a job. All right, well, Jim is not buying that.
No way, Peter, that's a myth. Of course, if you're an individual and you're looking for a job, you're going to second guess yourself. Dang, I should have gone into engineering or computer programming. Maybe that would help you as an individual. But for Canada's economy as a whole, this idea that there's a mismatch between the workers looking for work and jobs that are going unfilled because of the wrong candidates around, that mismatch theory is absolutely not supported by the evidence. We do collect data on how many job vacancies there are in Canada. There are not very many, about 200,000 across the whole labour market of 18 million people. And most of those have nothing to do with skills. In fact, the sector that has the most job vacancies, believe it or not, is hospitality and food service. Our workforce is the best educated in the world, according to the OECD. What we're really missing is employers who are willing to have some foresight, make an investment in training on the job specific skills, and perhaps bump up the wage a bit if there is, in fact, difficulty attracting the right people.
All right, a convincing argument. It's hard to imagine that anyone would disagree with you.
I can't imagine they would.
I think there may be three of us about to disagree. I mean, on the one hand, yes, what Jim is saying is true. If it's a hospitality job, that's not hard to train for. But the fact is, economists will tell you we're undergoing structural shifts in our economy, and when a manufacturing job disappears, the person that did that job isn't immediately trained for something else. And I've personally met people who've retrained 3 or 4 times only to find that job disappear on them as well. So almost by definition, there's a skills mismatch. If you're in a skilled job and you lose it, you're not skilled for anything else. You know, if you fire me, Peter, I don't know what I'm going to do.
I would never do that. Where are you, Patty?
I think there is a shortage in certain industries and in certain parts of the country, and that is in Alberta and Saskatchewan. In Saskatchewan, the unemployment rate is 3.5%. And in Fort McMurray, for skilled labor, there is a shortage. We have to bring in temporary foreign workers. It takes 4 years to train a boilermaker or a welder. We don't have time when the projects have to be done now. So there is, I think, a genuine shortage in regions like that.
Well, I'd actually add some color to the conversation by suggesting that a certain amount of a skills gap is actually healthy. Because if you're an employer and you can't find someone to fill that job, then hopefully over time you would raise the wages to attract people there. So when you take a look at some of these studies suggesting 2 million vacancies in X number of years, I think you have to take that with a bit of a grain of salt.
I don't know, Jim. You didn't convince them.
Surprise, surprise.
I think the facts are clear. Yes, certain employers in certain regions, Fort McMurray, fine. But Fort McMurray is not the microcosm of Canada's economy. And across the whole country, this idea of a mismatch is wrong. It's a shortage of jobs, not a shortage of skills, that is our fundamental problem.
Last week, we saw the latest unemployment rate. And it showed that the jobs were being created, that the number had gone down. Does that mean we have a stronger labor force?
Absolutely not. That's a myth, Peter. Canadians may be overjoyed, 6.8% unemployment, the lowest this cycle. But underneath that, there's a tremendous amount of slack in the labor market. We can see that the youth unemployment rate is still 13.5%. The participation rate, that's the number of Canadians in the labor force, is only 66%. That's the lowest since 2001. And wages are going nowhere. If this really was a robust labor market, wages would be rising. So I think it's a myth that 6.8% unemployment designates a strong labor market.
No, Jim, you must agree with that.
Oh, absolutely. In fact, the irony is if you give up looking for a job, you disappear from the official statistics, and that's what hundreds of thousands of Canadians have done. So the unemployment rate is not a good indicator.
But we should remember that there are some new types of jobs that don't count. So if I'm an Uber driver, am I counted? Is that a job according to StatsCan? If I rent part of my house on Airbnb, there's a whole new economy coming where we may actually have to start measuring things a little differently, and that may be somewhat showing up here.
Well, StatsCan has had fun this year trying to deal with its
Yes,
jobs figures, so maybe they will incorporate that. All right, let's move on to the next big myth. Myth number 2, here it is. Middle-class incomes are flat. This is a popular political refrain, fighting for the votes of the middle class by telling them their wages are not moving up.
The middle class is in trouble.
Well, who is the middle class? 56% of Canadians say they are middle class. 19% say they are lower middle class, 18% upper middle class. So in total, 93% of Canadians claim to be somewhere in the middle class. No wonder politicians are pitching to them.
The middle class. Middle class. Middle class.
So real or not, middle class incomes are stagnating. All right, Amanda, you buy that?
Well, this one is a myth. There are 2 problems with the data here. One is that we look at American numbers a lot, and Canadians sort of assimilated this idea of declining fortunes for the middle class, that median income. It's very true in America. It's less true here. And when you actually look at what's happened, we saw precipitous declines in the 1990s when nobody talked about it. Gigantic increases right up through to a couple of years ago, and a few years of stagnation, sideways moves. But if you look at the bottom we've come off of, we're back to normal. And frankly, as we see some big structural shifts happen post-crisis, flat looks like victory to me.
Preet.
I was going to actually echo the same thing. Over 30 years, there's been a big dip. So the first 15-year period, there was a decline in median family incomes. Last 15 years has been the complete opposite. So depending on what time frame you look at, 30 years looks pretty stagnant. Last 15 years looks pretty good. And I would argue that a 15-year time frame is probably more beneficial to look at than the last 30 years for deciding where policy should go in the future.
Patty.
But I think in terms of the numbers, that may be the facts. But I think if you ask the average middle-class Canadian, do you feel like your income today, are you any further ahead than you were 10 or 15 years ago? And I think they'd say no. Because I think, when was the last time you heard of someone getting a raise over and above the rate of inflation, let alone a raise? And the cost of living, yeah, we have the CPI, but I think most people feel that doesn't represent the true cost of living. So I think if you ask anecdotally, are incomes stagnating, I think the answer would be yes.
This could be a double-double for Jim and Patty agreeing on something.
Well, first of all, Amanda said no one was talking about it in the 1990s. I was talking about it in the 1990s, Peter.
Nobody was listening.
I may have been 12 years old at the time, but I was talking about it. Secondly, the fact we fell for 15 years, gained back a bit at least of what we lost, means we're now where we were 30 years ago, and that's not an accomplishment. 30 years of productivity growth, technological change, more women in the paid labor market, and median real family incomes are where they were 30 years ago. That is stagnation. So we absolutely do have a problem, and most of it comes from the fact that the income gains that have been created are going overwhelmingly to the top 10% or even 1% of the population.
Some of this gets hooked in with debt, and one of the things we're going to hear a lot about in the next year is that if you reduce the country's debt, it's going to be good for Canadians and the Canadian economy overall. Myth or not? Who wants to start that? Patty?
Well, it depends, I guess, in terms of are we talking federal or provincial? Because I think if I look federal, I think it's a myth that if we look at the debt to GDP ratio right now, it's 30%. That's very low. Driving it down further requires one of 2 things. You got to raise taxes or cut spending. Are Canadians really going to be better off in that scenario? But if you look at the provinces, I think it's a little bit of a different story. So the harmonized sales tax in Ontario is 13%. In Alberta, it's 5%. That's a huge difference, and that reflects the underlying fundamentals. So perhaps on a provincial basis, it might pay Canadians to drive down the debt, but on the federal level, I think, no, that's a myth.
Jim?
For the 3rd time tonight, I'm going to partly agree with Patty, certainly on the federal level. Here's the thing, there's an accounting angle to it. Because if you study accounting, you learn an asset is on one side, the liability is on the other side. So the government's debt shows up as their liability, but that means they've issued bonds to, say, pay for a bridge or something like that. We bought the bonds, and now we have the bonds on the asset side of our ledger. So what looks like debt to the government is actually wealth to Canadians, and it's an important part of wealth. Government debt is the most stable part of our portfolio. So if you issue bonds to pay for a bridge and Canadians own the bonds, are you poorer or are you richer? I actually think you're richer.
Well, yeah, but just to give some flavor to the conversation, if you take a look at the interest that we pay to service the debt, it's about $30 billion a year. So I'm not discounting anything that you've said, and I'm not suggesting that we should make a beeline towards zero federal debt over the next short-term period, because that would be wreaking havoc to the economy. But just for some food for thought, the amount of revenue we collect from GST is about $30 billion as well. So what it does is frees you up to do other things with the money.
Yeah, and I would agree. You should look at the provincial level where we do see a lot of this infrastructure requirement happening. We will see some debt taken on for longer-term assets, and that's perfectly reasonable. To me, that we have to remember the distinction between deficit and debts. Deficits is you're really living on borrowed dollars. Your tax dollars are going to creditors. They're not being used for operating purposes. And there was a brief time in the 1990s where we were paying down debt, and there's a real virtuous cycle in that. You don't want to be too zealous about it. It can hurt your economy. But when you start to pay it down, you really do start to free up cash, exactly the same way it feels when you pay down that credit card. You know, those interest payments don't help you at all. So there is some virtue in it.
Well, don't forget, on the federal-provincial split, there's an issue of what are the transfers from the feds to the provinces. That is part of the province's problem, and we will hear about that a lot in the run-up to the next election.
That brief time in the 90s, it was a tiny bit, but it was being paid down each year for a few years. All right. Myth number 3, big myth number 3, here it is. Raising the minimum wage is good for employment. Ontario's Liberal government just raised its minimum wage to $11 an hour.
This is a fair adjustment to the minimum wage.
NDP leader Tom Mulcair wants it as high as $15 an hour.
It's a priority in our society that people do earn a decent living wage.
They both argue it's part of ensuring economic recovery and a path to income equality. Business says any increase will cripple them and jobs will dry up. So, fact or fiction, raising the minimum wage will help jobs and the economy. All right, Patty, fact or fiction?
I suspect Jim's not going to agree with me on this one, but I'm going to say fiction. I think this is a myth. I think the Library of Parliament has looked at this issue, looked at all the studies, and the studies suggest the opposite, that when you raise the minimum wage, jobs are lost. And the reason for that is mainly because of small business. So when you raise the cost of labor, it reduces demand. And if that doesn't happen, then the costs get passed on to you and I as consumers, and that's not good either. Now, if you want to help people in lower income, I think there's other ways to do it, but not by raising the minimum wage. It's just too blunt an instrument. That's like if your car has a flat tire, you buy a new car. It's just a very inefficient way to deal with the problem.
All right, Jim.
Well, like the debt issue we talked about, there's two sides of the coin. Small businesses, a lot of them are restaurants, coffee shops, small retail shops. They depend on purchasing power in the economy to stay in business and keep people working. So a lot of the economic research, there's studies that can prove any side of this argument. A lot of the research says by boosting spending power in certain circumstances, it can actually create new jobs, a higher minimum wage. In general, I think the impact of a higher minimum wage on employment is hard to see at all in either direction, in which case you look at the equity dimension of it.
All right, I've got to take a break, but quickly, Preet?
I would say there's probably a combination of small, moderate, regular increases coupled with targeted tax relief for lower-income Canadians, which will achieve the benefit that we're looking for, as opposed to a drastic increase overnight.
To me, it just targets the wrong place. We're all worried about that median income, and there's no incentive by raising the bottom of it. You just put a bunch of young people out of work. To me, let's look at policies that encourage very wealthy corporations to raise wages overall across the board.
All right, we've got to take that short break, and that's no myth. When we come back, though, the stock market is a terrible place to invest right now, right? Fact or fiction when we come back. And welcome back to our myth-busting edition of The Bottom Line. Everyone's at the table tonight. Patty, Jim, Preet, and Amanda. Here it is, myth number 4. Whatever you do, don't invest in the stock market right now. It's just too volatile. A few days ago, the market dropped for the 5th straight day. Plunged, actually. Of course, then it soared on day 6.
Stock markets go up and down.
How'd that work for you? Actually, if you were one who held onto your portfolio in 2008, you are likely on the plus side. But 2008 exposed a lot of downsides of the market and the risks. Our last myth up for debate: the stock market is a terrible place to invest right now. And got hammered again today. Preet, Mr. Gambler. Where are you on this?
This is absolutely false. The stock market has been a fantastic place to invest, and even today, it's a great place to invest. If you look at the last 5 years, a balanced portfolio, which is not incredibly risky, 60% stocks, 40% bonds, returned over 10% over the last 5 years. You back that out to 10 years to include the global meltdown, it's just under 7%, which is still stellar. You go back 20 years to include the tech wreck, it's still over 7.5%. So what people are missing is that the trade-off is for long-term higher returns, you have to accept short-term volatility. That's the rule of the game.
Amanda.
Well, this is one where you have to do a bit of on the other hands, because first of all, if you're young, if you don't need the money that you're investing in the market, there is no better return. If you have a horizon, some would say 10 to 20 years, set it and forget it, do a broad portfolio of stuff and don't worry about it. But if you're not, and you actually need to live on your income and it's invested, it's a kind of a tricky place right now. We're living in a yield-free world, and when you get yield, you're getting risk. Just one of the oldest rules in the book. And every time people forget it, bad things follow. And stocks are giving you a good return, and that means they're giving you risk. So if you're 65 and you can't afford to have another 30% decline, you need to take a good hard look at what you're investing in.
Patty.
Well, I think the headlines right now are very scary for Canadians, but try and take emotion out of the equation. So to me, yeah, the stock market's going to beat any other investment in the long term, but to me, it's about disciplined rebalancing. So what I mean by that, Peter, is right now, if you looked at your portfolio, say it was 60% stocks, 40% bonds, you're going to be low on stocks and high on bonds. That's going to force you to sell bonds and buy stocks. You're buying the undervalued asset. So my advice is, again, ignore the headlines. I know that's tough, but take the emotion out, and it's disciplined rebalancing that's really going to get you that rate of return.
All right, Jim, you going to take the emotion out?
Well, we've heard about the kind of personal investment decisions about the stock market. There's another issue, which is the economic role of the stock market. In theory, the stock market is supposed to be a place that raises money for growing investments by new innovative companies. But in practice, that hasn't been happening either. IPOs, initial purchase offerings, which are the way they raise money for new capital, have been very, very rare. More companies are actually buying their shares back. So it has become a bit more of a casino and less of an economic driver. I think that's a bit of a problem as well.
All right. Quick last question. You're the only one who gets it, Amanda. Why are there so many myths associated with the economy and covering it?
Two things, and we've seen a bit of it here tonight. Data can be manipulated in different ways, and so people will manipulate it to make their own point. And once they've done that, they really like to, it's confirmation bias. Once we think we've arrived at an answer, we like to hang on to that. We're not really, as humans, open to thinking we may have got it wrong somewhere. So I think you see people dug into positions and they don't like to get out of them.
Unlike the four of you.
Unlike us.
Always flexible. Thank you all.
Thank you.
And thank you as well. We're sure you have some myth ideas too, and if you do, send them along. Check out our website at cbcnews.ca/thenational.